Imagine paying money every month, not because something happened, but because something might happen. A car crash, a hospital bill, a house fire, a sudden death, a storm, one bad day. Now imagine a company standing in the middle of all that fear, collecting money from millions of people, every month, every year, for decades. That company is called an insurance company. And insurance is one of the most powerful business models in the world. Because insurance companies do not only sell protection, they sell peace of mind. They sell the feeling that if life hits you hard, you will not be destroyed. But here's the part most people never think about. For an insurance company to become rich, most customers must pay more than they ever get back. That is the game. You pay because you are afraid something could go wrong. The company makes money because most of the time nothing goes wrong, or at least not enough goes wrong for everyone at the same time. That is why insurance is not just a service, it is a machine built around risk, fear, math, contracts, and time. Let's break it down. At the simplest level, insurance works like this. A large group of people pay into one big pool of money. Some people in that group will face accidents, sickness, damage, or loss. When that happens, the insurance company uses part of the money from the pool to pay them. And honestly, that sounds fair. Because if your house burns down, most people cannot just pull hundreds of thousands of dollars out of their pocket. If you crash your car, the repair bill can be painful. If someone gets very sick, the medical bill can be bigger than their entire savings. So, insurance exists because life is unpredictable, and in many situations, insurance is useful. Sometimes it saves people, families, sometimes it saves businesses. But the business side is where things become interesting, because the company is not guessing, it is calculating. It studies your age, your location, your job, your health, your car, your home, your driving history, your past claims, your lifestyle, and sometimes even the behavior of people who look similar to you statistically. The goal is simple. The company wants to know one thing. How likely are you to cost them money? If the risk is low, they may charge you less. If the risk is high, they charge you more. And if the risk is too high, they may refuse to cover you at all. This is where the business becomes cold. To the customer, insurance feels emotional. It feels like safety. It feels like someone is promising to protect you. But to the company, you are a risk profile, a number, a calculation. And the company is asking, how much can we charge this person so that over time we still make a profit? That monthly payment you make is called a premium, and premiums are the lifeblood of the insurance industry. Every month, millions of people pay premiums. Car insurance, health insurance, home insurance, life insurance, business insurance, travel insurance, phone insurance, pet insurance. Some people pay for things they may never use, and that is exactly why the model works. Most people will not file a big claim this month. Most people will not crash their car this year. Most houses will not burn down. Most travelers will not lose their luggage. Most people paying life insurance will not die this year. So the company collects money from many people, pays claims to a smaller number of people, and keeps the difference. But that is only the first layer. The second layer is even more powerful. Insurance companies often receive money long before they have to pay it out. Think about that. You pay today, but the company may not pay a claim for months, years, or maybe ever. So what happens to the money while it is waiting? They invest it. This is one of the biggest secrets behind the insurance business. Insurance companies do not simply collect premiums and let the money sit there. They invest huge amounts of it in bonds, stocks, real estate, and other financial assets. This money is sometimes called float. Float is money the company holds before it may need to pay claims, and if managed well, float becomes extremely powerful. Imagine someone gives you billions of dollars, and you are allowed to invest that money before giving some of it back later. That is a massive advantage. This is why some insurance companies feel more like financial giants than simple protection companies. They are not only making money from premiums, they are making money from time. The time between when you pay them and when they pay someone else. The longer they can hold that money, the more opportunity they have to grow it. That is why insurance is deeply connected to finance. But there is another part of the system, the part customers often hate: claims. A claim is when you ask the insurance company to pay you. This is the moment when the friendly promise becomes a real test. When you are buying insurance, the company wants you to feel safe. The advertising is warm, the family is smiling, the music is soft, the voice is calm. The message is simple: we are here for you. But when you file a claim, the company now has to protect its own money, and this is where the tension begins. You want help, speed. You want the biggest fair payment possible. The company wants to pay only what the contract requires, not more. Sometimes the claim is simple, and the company pays. Other times they investigate. They ask for documents, they check the details, they look for exclusions, they study the fine print, they ask if the damage is really covered. They may offer less than expected, may delay, may deny. And to be fair, not every denial is wrong. Sometimes customers misunderstand what they bought. Even people exaggerate or commit fraud. Fraud is a real problem in insurance. But from the customer's point of view, it can feel brutal. Because the worst time to read the fine print is after something terrible has already happened. This is one of the most important lessons about insurance. The promise is emotional, but the contract is legal, and the contract always wins. That document you clicked through quickly, policy you signed without reading, small text at the bottom. You may decide whether you receive money or not. The big print sells comfort. The small print defines reality. And insurance companies know this, that most people do not read every word. They know most people buy based on fear, trust, price, or because the law forces them to. Car insurance is required in many places. Home insurance may be required by a mortgage lender. Health insurance may be tied to a job or government rules. Business insurance may be required before signing contracts. So in many cases, insurance is not really optional. It is part of modern life, and that makes the industry incredibly strong. Because customers do not only buy insurance when they feel like it, many people must buy it. That creates stable, repeated income, month after month, year after year. The best businesses in the world love recurring payments, subscriptions, memberships, monthly plans, and insurance is one of the oldest subscription businesses on earth. You pay again and again, hoping you never need the product. That is strange, but it is brilliant. Imagine paying for a service and being happy if you never use it. That is insurance. And because of this, insurance companies spend huge money on marketing. They want to be the name you trust before you are afraid. They want you to think of them when you buy a car, a house, start a family, a business, when you get older, when you think about death. Insurance is connected to major life moments, and major life moments are emotional. A new baby, new home, first car, sick parent, risky trip, business dream, fear of leaving your family with nothing. Insurance enters the room exactly when people are thinking about what they could lose. That is why the industry is so powerful. It does not need to create fear from nothing. Life already creates fear. The company just gives that fear a price. And once fear has a price, it becomes a monthly bill. But what happens when a disaster is too big? What happens when thousands of people file claims at the same time? A hurricane, flood, wildfire, pandemic, massive accident. This is where another layer appears: reinsurance. Reinsurance is insurance for insurance companies. Yes, even insurance companies buy insurance. If one company has too much risk, it can transfer part of that risk to another company. That way, if a huge disaster happens, one insurance company does not carry the entire burden alone. This creates a global web of risk. Your home insurance company may be backed by another company, and that company may be backed by even larger financial institutions. Risk moves around the world like invisible money. The customer usually never sees this. You just see your monthly bill, but behind that bill is a huge system. Data, contracts, investments, lawyers, analysts, claim teams, and global finance. Now let's talk about why insurance companies can become so profitable. First, they have scale. The more customers they have, the better their math becomes. If you insure 10 people, one accident can hurt you badly. But if you insure 10 million people, patterns become more predictable. The company can estimate how many crashes, fires, medical claims, or deaths may happen in a year. Not perfectly, but close enough to price the risk. Second, they have pricing power. If costs rise, premiums can rise too. If cars become more expensive to repair, car insurance becomes more expensive. If medical costs increase, health insurance becomes more expensive. If storms become more damaging, home insurance becomes more expensive. And the customer often has limited choices. You may complain, compare prices, switch companies, but in the end, you still need coverage. Third, insurance companies are very careful with wording. Every policy has conditions, limits, exclusions, deductibles. A deductible is the amount you pay before the insurance company pays. So even when you are covered, you may still pay part of the cost yourself. This lowers the company's risk. There are also coverage limits, meaning the company may only pay up to a certain amount. Again, this protects the company. Then there are exclusions, things that are simply not covered, and this is where many people get surprised. They thought they were protected, but the contract says otherwise. This does not mean insurance is useless. It means insurance is specific. It protects you from certain things, under certain conditions, up to certain limits. And that is very different from the simple feeling of, I am covered. Insurance companies also fight fraud. Fraud can be fake accidents, exaggerated damage, false medical claims, staged theft, or people lying on applications. Fraud costs the industry a lot of money, so companies build systems to detect suspicious claims. That makes sense. But it also means honest customers may sometimes feel like suspects. When you file a claim, you may be asked to prove everything: photos, receipts, reports, dates, medical documents, police reports, repair estimates. The company is not only asking, how can we help? It is also asking, are we sure we have to pay? That is the nature of the business. And this is why the relationship between people and insurance companies is complicated. People need insurance, people are thankful when it works, but people hate it when they pay for years, and then feel abandoned when they finally need help. This emotional conflict is at the center of the industry. Insurance is both protection and business, comfort and calculation, safety net and profit machine. It sits right between human fear and corporate math. Let's use a simple example. Imagine 100,000 people each pay $100 per month for insurance. That is $10 million every month. In 1 year, that is $120 million collected. Now imagine the company pays $75 million in claims and expenses. There may still be tens of millions left, and while some of that money waits, it can be invested. Now scale that from 100,000 people to millions of customers across cars, homes, health, life, travel, and businesses. That is how the numbers become enormous. The customer sees a monthly payment. The company sees a river of cash. And the goal is simple. Keep the river flowing in while controlling how much flows back out. This is also why insurance companies care so much about risk behavior. They want safer drivers, healthier customers, stronger houses, fire alarms, security systems, regular checkups, lower risk lifestyles. Because when customers have fewer claims, the company keeps more money. This is the strange part. The company profits when nothing bad happens to you. So in one way, your interests are aligned. You do not want a disaster. They do not want your disaster either. But if disaster happens, your interests can become opposite. You want the biggest fair payout. They want the smallest required payout. That is the tension. Now let's talk about fear. Fear is one of the strongest forces in business. People buy things for pleasure, but they also buy things to avoid pain. Insurance is built almost completely on avoiding pain. The pain of losing a house, of leaving your family with debt, of a hospital bill, of being sued, of a car accident, of one unlucky moment destroying years of work. And when people imagine those moments, they become willing to pay, not because they want to, but because the alternative feels worse. That is what makes insurance different from many products. You do not wake up excited to buy insurance. No one says, I cannot wait to pay my premium today. People pay because not paying feels dangerous. This is why insurance marketing often shows family, safety, home, protection, future, and trust. It rarely focuses on the boring contract. It focuses on emotion. A child sleeping safely, father looking at his home, mother driving her family, business owner opening the door in the morning, couple planning their future. The message is not just buy insurance. The message is protect what matters. And that message works because everyone has something they are afraid to lose. But here is the key question. Is insurance bad? No, not automatically. Insurance can save people from financial disaster. It can help rebuild homes, pay medical bills, protect families after death, keep businesses alive after accidents, make modern life possible. Without insurance, many people could not drive, buy homes, start businesses, or take certain risks. Insurance spreads risk across many people. That can be very useful. The problem is not the idea of insurance, it's when people buy it without understanding it. When they think every situation is covered, choose the cheapest plan without reading the limits, do not know the deductible. When they do not understand exclusions, when they trust the advertisement more than the contract. That is where people get hurt. So the real lesson is not never buy insurance. The lesson is understand what you are paying for. Know what is covered, what is not covered. know how much you must pay before the company pays the maximum amount they will pay. Know when they can deny the claim, and never confuse the feeling of safety with the actual terms of the policy. Because insurance companies are not charities, they are businesses, very smart businesses. They hire experts to price risk, lawyers to write contracts, analysts to study behavior, marketers to build trust, investors to grow the money, claim teams to control payouts. Every part of the machine has a purpose: collect more, pay carefully, invest the float, manage risk, protect profit, keep customers coming back. That is the insurance machine. It works because life is uncertain and grows because fear is universal. And it becomes powerful because time is on its side. Every month that nothing happens, the company wins, you keep paying, the pool grows. Every policy renews the relationship, every fear becomes another product. Car insurance for accidents, home insurance for fires and storms, health insurance for sickness, life insurance for death, travel insurance for lost trips, business insurance for lawsuits, phone insurance for broken screens, pet insurance for sick animals. Almost every modern fear can be packaged, priced, and sold. And once you see that, you start noticing insurance everywhere. At the airport, the bank, the car dealership, the hospital, on your phone, in your job, inside your mortgage, your credit card. Insurance is not just an industry, it is a hidden layer of the modern economy. It quietly sits behind almost every major risk people take. And the reason it makes so much money is simple. People are willing to pay today to avoid a nightmare tomorrow. That sentence explains the whole business. You pay today for a nightmare that may never happen. And if it never happens, the company keeps the money. If it does happen, the contract decides how much help you actually get. So next time you see an insurance commercial with soft music, smiling families, and the word protection, remember what is behind it. A massive financial machine, built on data, powered by premiums, protected by contracts, growing through investments, and driven by one of the oldest emotions in human history: fear. Insurance companies understood something very important. Fear has value, and if fear has value, someone will build a business around it. They turned uncertainty into monthly payments. They turned risk into numbers. They turned peace of mind into one of the richest industries on earth. And the most interesting part, most customers keep paying, hoping they never need to use what they bought. That is the genius of insurance. You are not paying because something happened. You are paying because something might happen. And in that small space between maybe and what if, billions of dollars are made.